AM 1220 KDOW and Money 2.0 present The Real Estate Report with Tony Mendez and Gordon Hines.
Bay Area real estate and mortgage experts with over 25 years in the business.
Now, with an in-depth look at this week's local and national real estate news and what it means for you. Your hosts, Tony Mendez and Gordon Hines.
Welcome back. Welcome into the Real Estate Report. I'm Tony Mendez.
And I'm Gordon Hines.
Thanks for joining us today. We are live, coming from the Bay Area. You can always call the show 800-516-1220, 800-516-1220. If you have any questions, or you can email us, Tony or Gordon at bayarealoansource.com. Mortgage rates continue to climb since last week and in the previous week, so we've had a couple weeks of increased rates. It's about a tenth of a percent. It's starting to get noticeable now, Gordon. Freddie Mac has the weekly survey for the 30-year fixed at 3.09%. And the 15-year at 2.33%. I remember when the 30-year was down there, and the 5-year ARM at 2.5%. That can actually be lower in some cases. So nothing wrong with the 5-year ARM because it's amortized for 30 years now. Do you start looking at the ARM now as these long-term rates start going up?
Yeah, as the 30-year fix starts to climb above 3%, I think now there'll be a wise opportunity to start looking at the 5 to 7-year or even a 10-year ARM. A lot of times, we always talk on the show many times, people refinance over and over again, even though we opt for the 30-year, but a lot of times it's in 3 to 5. I think the average person stays on mortgage about 6 years. So if you can figure that out, why go for the 30-year fix? But fortunately, during that time when mortgage was at its lowest, the 30-year was lower than the 5-year. So, but as rates begin to go up, they start to invert each other. So now we start preaching to start looking at those shorter term ARMs if you are in the market for a fixed rate still.
You brought something up that intrigues me. People still get in and out of mortgages. They still refinance, but we've gone through a pretty unique era of low interest rates, the lowest interest rates we've ever seen. And I think anybody who could have refinanced did refinance, and they have the lowest rate they think they're ever going to get. Why would people refinance, Gordon, every 6 years if they're in that low interest rate? Is it just to – I can't imagine it's just to re-amortize and at a higher interest rate so I can get a lower payment, but you're paying more interest. Or is it just cash out?
Well, there are people that refinance just for the sake of refinancing. I've seen people – customers we know that refinance every 1 or 2 years, regardless of what the rates are. People refinance for different reasons. Life circumstances can cause us to refinance unexpectedly. One person dies, kids going to college, need to buy a second home. They need to buy a car. A lot of different reasons why people refinance. A lot of times the benefit is for cash out, of course. That's the only reason why you would refinance is for the benefit of cash out. So regardless how low the rate is, since we know that the lowest rates come on your primary residence of the mortgage, if you are going to refinance, even if you do have a low rate and you have a necessity for cash, your best bet is to take it out your home, even though rate be slightly higher than what you currently have now.
So I think people are going to start, even though it is some of the cheapest money, and we do see some inflation coming, we see mortgage rates going up, and you're saying that people are just going to do it anyway. There's multiple amount of reasons to do it, not just to lower your interest rate. But from the Mortgage Bankers Association, they came out and they said that mortgage originations is going to drop 33% in 2022 as interest rates rise as well. And they're saying that refinance originations will drop 62% in 2022. That 62% drop in originations, how's that going to affect? Obviously, it's going to affect a lot of people or industry, the banks, the large brokers, the small brokers especially. That's still a sizable amount to predict, even if they're half of that, 32%, for example, in decrease in origination. That's a pretty big number, Gordon. Meanwhile, they say that mortgage origination for buying is going to go up a little bit.
Well, it's a big number. As we talked, the mortgage business is probably one of the biggest industries in the country. As the mortgage industry goes, so does the real estate market goes, so does the economy. If you're talking about refinances dropping 30%, 60% in 2022, just think the number of jobs that are going to be affected. banks, title companies, appraisers, home inspectors, insurances, all those people that feed off for that industry will see a drop off in income or opportunity. One of the biggest lenders that we work with had a big layoff this week already. They laid off 18 people because they're
18?
anticipating. Yes, they're anticipating that volume would fall off come close to the end of the year. And as rates begin to rise, we're already starting to see it. So the mortgage industry, like everything else, they rev up when the business is busy, and they also rev down when there's no need for all those extra bodies and extra paychecks.
According to Mike Frentinelli, he's the chief economist at the Mortgage Bankers Association. He says with inflation elevated and the unemployment rate dropping fast, the Federal Reserve will begin to taper its asset purchases by the end of the year and will raise short-term rates by the end of 2022. Overall, this will mark a change from the record high production profits of 2020 when interest rates fell to record lows and home buying demand soared due to the coronavirus pandemic. He continues to say, Marina Walsh, the vice president of industry analysis at the NBA, many lenders will rely more heavily on their servicing business to achieve financial goals. So there's some big, these are the people that are working with banks, the Mortgage Bankers Association, and they're saying that they're already predicting what's going to happen. We're either going to work with just buyers, we're going to kind of forego the refinancing as we see that dwindling a lot, and we're going to go to our financial services. I see this as a big shift in the industry for a lot of people like us who we've been around for a long time. I feel very fortunate that we're going to continue working with the clients that we work with and have very good relationships. But I feel bad for some people that are getting in the business. I think there's going to be more jobs lost. It's not just going to be those big lenders. Did you say 18 or 1,800?
18.
Just 18 people?
Yeah, just 18 people. I mean, that's a considerable amount of people to be laid off if you think about it, depending on how large the company is.
I think that's going to be a much, much bigger number next year.
The bigger the company, of course, the more they're going to lay off. The title companies will start to lay off people because, once again, they all rev up to handle volume, and these are the effects that you see on the marketplace. I think about every 4 applications is three of the refinance, 1 of the purchase. I think you'll see that swap comes for every 4 applications. Probably see 3 of purchases, 1 of the refi. As the market changes, we just have to do different things and different adjustments and kind of adjust with the marketplace. Of course, as rates go up, volume tends to fall off simply because of people don't need to refinance to get the lower rates right now. But there's always a need for refinance because there's always a need for cash.
So I think the reason we're talking about this, not a lot of people out there probably want to know what's going on in the mortgage side. They just want low rates. They want it easy. They want it fast. They want the best price, the best costs. It's because you have an organization, association here in this case, that's basically saying we're going to see a drop off. And we're going to make some moves, and that's because of higher interest rates. We see it coming.
And one of the things that we always talk about, as mortgage volume starts to drop off, you start to see more programs come on the marketplace. You find the market becomes a little bit more flexible.
It could be the silver lining, right?
Underwriting guidelines tend to loosen because we have to create industry in order to keep the business going. And that's what you typically see. More and more products, more opportunities for people that were left out, overlooked, as the market kind of tightens.
I see this as just part of the cycle, as you do. I know you do. You've seen more cycles than I have, and some of these older homeowners that have been refinancing every 6 years, according to you.
On average.
On average, according to you. I want to say according to you. Okay. According to you, every 6 years. And that's pretty close. We don't know what the number is, and it is going to change as people have locked in those low interest rates. But we're going to see these people who have owned their homes for a while. They've seen these cycles. We're going to cycle. We know that. How do you think it's going to play into the stock market? Because a lot of people there's a whole another segment we're going to talk about the buyers that are out there right now. There are a bunch of buyers out there that have been relying on some good returns in the stock market, or have felt really good about spending other money because their stock portfolio has done very well to buy houses. And now we're starting to hear a little bit, about inventory issues and home prices getting too high, affordability issues. So we're starting to see a lot more signs. And that's one of the things you hear on the show a lot is us talking about the signs. And when we start they start multiplying and adding up to each other, it really starts you start really seeing the bigger picture.
Yeah, as we always talk on the show, signs and wonders, as we kind of call it. Of course, days on the market is one of the key indicators when we're looking at real estate and how long properties get on the market. As we talk on the show, over the last couple of weeks, I'm seeing a lot of price change, a lot of price reductions in the marketplace. And believe it or not, sometimes those houses go back over higher than the actual purchase price when those purchase prices are actually lowered. A lot of different things going on in the marketplace. Still a lot of people out there with a lot of money being made in the stock market. I was listening to this show the other day. The guy was saying people are going to be in for a rude awakening come the end of the year. All the money they make in the stock market, and they realize they have to pay tax on that money and then account for it because they're not paying estimated taxes. So a lot of different things going on in the market. A lot of young people making money, stock options, IPOs, all kind of things. So still a lot of cash out there circulating. The market is not dead by no means. I think it's just going to reshape itself into a different concept as times change and the Federal Reserve tighten the money supply.
And we're right there along with you guys. We keep talking about these interest rates right now. Freddie Mac's weekly survey showing 3.09%. Depending on where you go, Mortgage Bankers Association has that a little bit higher. It depends. It's all about the trend, and it has been trending up higher. So with that said, we don't really know what's going to happen in 2022. Nobody does. We could see the stock market crash. We might see the Fed basically say, we need to lower interest rates. We don't know. We don't think they will, especially as we see these unemployment numbers continue to decrease. With that said, you can call the show 800-516-1220, 800-516-1220 to get your calls on the air. The rental market is interesting out there too. And this has been tough. This has been tough on especially millennials. We're going to get into that story a little bit later about who's buying what and how the millennials, which is the largest group of buyers out there, the largest generation ever, they've been struggling with seeing rents increase and home prices increase, hurting their ability to save money. 11% from this year of increase, a year-over-year increase in rents, and a 15% increase in the median the mortgage payment, that is. So they're seeing both ends of the transaction. They're seeing the rents go up, and they're seeing it getting pricier to buy homes. At some point, again, do you call this another sign where this is just like getting into too much debt? This is like watching our consumer debt increase over a period of time and saying, something's going to break. People are, they're going to run out of cash to get out of their house, or interest rates going to rise. They're not going to do transactions. So there's a lot of pieces going.
Well, one of the things in the bill that they're trying to pass is, of course, free college education for the first 2 years, and also $37 billion assigned to affordable housing, which will really help the millions out.
We're going to talk about that, the affordable housing, and we're going to talk about some changes that the administration is trying to make to help people get into homes and products that have lower interest rates. We'll come back after this break. I'm Tony Mendes. That's Gordon Hines. This is the Real Estate Report on AM 1220 KDOW. Be back after this break.
Questions about real estate? Call the program, 800-516-1220. Now, back to the Real Estate Report on AM 1220 KDOW.
Welcome back into the Real Estate Report. I'm Tony Mendez.
And I'm Gordon, the Maestro Hines.
Play us a song, Maestro. New home construction or new home purchases for applications for new homes fell as construction costs rise. They fell 16.2% from September levels of last year. And that's based on the volume of applications and assumptions regarding the market covering other data. The Mortgage Bankers Association estimates that new single-family homes were running at seasonally adjusted rate, 843,000 units. That's 3.5% decline from August pace. So that's not really good news. The sentiment's still kind of there from builders, but with people moving all around the United States, Gordon, the work from home, that really fell into place for a lot of people. A lot of people waited, and then they started seeing how that was playing out for them as we saw low interest rates and home prices rising. They wanted to get in. That was a really good piece that fell into Corona during the pandemic, was the work from home mentality and philosophy that these companies took, and a lot of people engaged in it, and they really took advantage of being able to move. Places like Sacramento or Reno or even much further, Denver, there were some companies that were offering incentives for people to move out of the state. And then the lenders were saying, we're okay with it now. And they weren't fighting us. They used to fight us over that. In fact, you had one today. I think you had lenders put a condition on there saying, well, I need to explain a little bit about why
Distance to travel.
Distance to travel. Or we get a letter from the employer saying you can work from home. And they're getting a lot looser on that. So that used to be one of those mountains to climb. Now it's a small speed bump.
Yeah, because it's a sign of the times. If I could talk to a client today, she just moved from Walnut Creek to San Diego. And I said, well, what about your job? She says, well, I'm 100% remote. So I moved to San Diego to be closer to my family because she was up here for a job assignment. And now she's in San Diego working for the same company based out of here of the Bay Area and still enjoying all the benefits, no salary drop and all that kind of thing, and still getting the benefits of being close to home. So a lot of things have happened. We always thought we'd be having any dark clouds of silver lining. That's one of the silver lines that's happened behind COVID. A lot of things that it looks like we're getting COVID under control here in California with the mandates as far as the vaccines and things seems to be working. Keep our fingers crossed. I'm excited. I think that's going to lead the economy to open up in the first quarter of 2022. And as the market goes through another change, I think that's going to be a big part of the change in 2022. A healthy market as far as the economy and the health of our citizens are concerned.
I want to bring up the guidelines and how the lenders are really working with the buyers that are working remotely. What that means is that when you're looking at, let's say you go to Austin, Texas, or Provo, Utah, or anywhere, and you're out of state, you're much further than where you're currently living. It also means you can buy it as a primary residence, which means you follow primary residence guidelines, which means you in the standard, that's FHA, that's Fannie Mae, that's Freddie Mac, and even the jumbo with 10% down. No mortgage insurance, by the way, on that, in most cases with the right credit score. And income, of course, qualifying. So all you got to do is get a letter saying that's where you're going, right? You get a paycheck. And next thing you know, you're buying as primary residence, which helps you with your down payment. So a lot of people who have been struggling with high rents, especially in a place like the Bay Area, who is moving to an area where they can put 3% or 3.5% down, depending on what product they're using, that's helping a lot of people move that haven't had a lot of money, but that is going to have a good income in a more affordable area. I think that's just, those pieces really fit together. Now, as these interest rates rise, it's getting a little bit more challenging, and we're seeing compounding events here. We're seeing the home prices creep up, especially in places where jobs are at, and we're seeing a lot more activity and a lot more people moving. And then we're seeing the interest rates rise.
But as we spoke last week, once again, another tool for 2022 is the mortgage limits are being increased. Mm-hmm. We're going to go up to 625.5 on a standard single-family homes in most of the high-cost counties. I found a document on my desk, in my drawer. I keep a lot of papers in my drawer, going all the way back to 2009, believe it or not, where the median, the loan limits were $417,000.
They didn't have high balance back then. It was just $417.
And I figured out between $417 and 2009, 13 years later at 625, that's $208,000, about $16,000 a year in increase on the loan limits, which actually is a huge factor as prices continue to rise. It just makes it easier to qualify for a loan because it's easier to qualify on the conforming loan limits than some of the big jumbo products, especially with the smaller down payments. So it all goes hand in hand in the higher debt ratios.
And it makes sense. Guidelines can really push people into homes. And we're already hearing the administration saying they want to do and act on this to help first-time homebuyers get into houses. One of the things that they're going to do is they're pushing the Federal Housing Finance Agency into helping open up some of the guidelines with their programs. And it's something called Fannie Mae. Is it Home Possible? No, is that Freddie Mac Home Possible and then Home Ready? Home Ready. Those are two products. One's by Fannie Mae, one's Freddie Mac. And they might as well be the same. They use the same income limits, and they're bumping that up from 80% of the median adjusted income in that area, in that zip code, to 100%. So we've actually run across this product a lot, but people make too much money to qualify for this. Now they're raising it up to 100%. You can easily go to Home Ready or Home Possible income limits at Google, and you can find out where, and type in your zip code, pops right up, and it'll tell you if you qualify for this. And the reason why it makes a difference is, and yes, you might have to take what they call like a 15-minute course that you do online.
You have to take a homebuyer's
course. The rates are lower.
Well, it's a lot of benefits. Once again, on paper, it might not sound too exciting, but in reality, it is exciting because, one, you get a lower rate. Two, the MI is lower
mortgage insurance for people who don't know
the
what it is.
qualifying ratios are higher, so it's a lot of benefit for going from 80% medium income to 100% medium income in a qualified census tract. It doesn't sound exciting on paper, but believe me, it's another thing to help you qualify, to help the market move in a different direction.
Now, it's my opinion, though, that it's a little too late. Too little, too late. I think home prices are going to eventually keep going up as inventory goes down. We're going to get into some more reports about that as well as talking about who's actually out there buying these properties and continually driving up prices. That's something we definitely want to get into. I think it's too little, too late, Gordon. I think that you still have to qualify. That's the big kicker. There's no program out there that just says, you can buy this house because you're a certain race or a certain income limit or a certain, you know what I mean? There's nothing out there that does that. You still have to qualify. And I think at some point, affordability is going to trump all of these programs. Don't you agree? In some fashion where it's just, the administration come out and blow a lot of, hot air, and then it turns into smoke.
Well, that's another economic indicator that we always talk about is affordability. Affordability is one of the big factors in affordability is the rental market. We talk on the show many times before on minimum wage. Most people cannot qualify for a standard 2-bedroom, 1-bath house, not only in the Bay Area, in America, and that's the reason why we're beginning to see a lot of homeless people. Actually, I saw a program on TV the other day where there are many homeless people out there that have jobs, that go to work every day, but are homeless because they simply cannot afford to rent in these high-cost areas. And that's where government subsidies come in. That's where, once again, $37 billion is slated for the budget as far as affordable housing. There's a difference between affordable housing, low-income housing. All these things is what we need to keep the market balanced.
Yeah, unfortunately, it still feels like this, and you guys have heard me say this before. The haves are really having a run at this, where the have-nots are living in. I have a friend that lives in Utah. He and his boss said, "Yeah, come out to Utah. I'll pay you good money." But he had to buy a third wheeler to live in for him. He can't afford an apartment. We'll come back after this break. You can always call the show, 800-516-1220, 800-516-1220, or email the show, Tony or Gordon at BayAreaLoanSource.com. We'll come back after this break here on AM 1220 KDOW.
Phone lines are open on the Real Estate Report. 800-516-1220. That's 800-516-1220.
Welcome back into the Real Estate Report. I'm Tony Mendez.
I'm the maestro, Gordon Hines.
When are you going to play us a song?
Pretty soon. I'm working on it.
All right. I'll settle for the beatboxing.
Fair enough.
Mic's open.
Next week.
We'll practice up. Fewer homes for sale in September as declining numbers of listings holds. New listings of homes for sales fell 9% from year earlier, and closed home sales were down 5%. Median sales price, $376,800 in September 2021 in the nation. And month over month, that's a 1.6% increase in sales, but year over year, 5.4%. So we're seeing a little bit, it's great to see this time of the year that we're seeing a little bit of increase in sales, but the inventory is still super low, Gordon.
Inventory is super low, which is, once again, supply and demand. The lower the inventory, the higher those costs are going to be. So until there's a change in the mechanics of that, I think the sellers are still going to out-trump the buyers. I came across this interesting article in the 24/7 Wall Street. It says most educated city in California. Any idea?
Marin.
Los Altos. Los Altos is about 30,000 people. Average 84% of the people living in Los Altos have a college education. Average college education in the United States is about 35,000. And as we talk once again on one of the programs, they're trying to pay for 2 years of free community college education. The biggest expense with all the millennials trying to get into the housing market is they're burdened with these high student loan debt. So this is another issue when we look at success and who does what, when, where, and how. In order to be successful, of course, the more education you have, the more successful you be. On a general standpoint, not synonymously, but these are one of the things that affects housing, of course, is the education.
When you talk about the millennials and paying for an education, getting student loans, getting a great job, coming to the Bay Area, for example, and then living in a unit. I was at lunch today. It was it was a couple. It was the mother and then the couple, and the guy was talking to the mother. And he's like, oh, yeah, I live in a 750 square foot unit. You know, I like to cook more and I need a bigger place. And I was like, but that's what a lot of these millennials are doing. They're living in these smaller places. And then they want to get a house. And those are the struggles. And they're fighting. It's an uphill battle. And we're seeing some real numbers come out why older buyers have such an advantage in today's market over the millennials. In 2009, people's ages 18 to 39 made up nearly half of the home buyers, according to Zillow. By 2019, that number's gone down to 42%. And simultaneously, adults 60 years and older went from 16% of home buying in 2009 to nearly 25%. And obviously, the ones in the middle, Generation X, are picking up the slack. But but they're saying now that those, so suppressing that largest buying pool that's out there, that largest buying generation out there, is I think it's going to be I think we're going to see a lot more of effect of that in the market than we want, and we're going to start seeing people spread out a little bit more. I want to talk a little bit more when we come back after this break about this. You're always welcome to call the show, 800-516-1220, 800-516-1220, or shoot us an email, Tony or Gordon at BayAreaLoanSource.com. That's Tony or Gordon at BayAreaLoanSource.com. We'll be right back after this break.
Got a question? Run it past these guys.
800-516-1220.
It's the Real Estate Report with Tony Mendez and Gordon Hines on AM 1220 KDOW.
Welcome back into the Real Estate Report. I'm Tony Mendez.
I'm Gordon Hines.
So older buyers they have the advantage when house hunting. They have many years of either owning a home and moving equity to the new home, or they're able to buy homes in cash. They have larger incomes than millennials, which is the largest buyers generation ever. And they're more likely to also do all cash offers, which shows to help, in research that they're going to get their offer accepted before yours if you have a loan. So in 2009, there's some stats about this, Gordon. 2009, the median home buyer age was 40. That's crept up to 44 as of 2019, and then retreated a little bit to 43%. In the millennial generation, they're still purchasing more homes, but that's decreasing. It's 37% of sales going to buyers between 27 and 41. Gen X makes up 25%. And the silent generation, believe it or not, it's buying just as many as Generation Z. So there's it's interesting, how it's not going unnoticed is what they're saying, that the where the money is what's buying homes right now.
Well, you figure population is living longer, so technically, as population lives longer, you're going to find older people are now going to start selling homes and making more moves, simply because typically, as population grows older, our health standards are getting better as we get older, simply with technology and medicine. So modern day medicine is probably a good economic indicator to why that particular statistic is valuable. And I think these are all the things that are, once again, every year changes the fulcrum of where we were compared to last year. And when we look at all these things and we always trying to predict the future, what the housing trends going to be, what the buying trends are going to be, what the real estate trends are going to be, what the rate trends are going to be. These are all the things that you kind of look at if you're a betting person trying to bet which direction the market's going to go.
One of the trends we actually thought we were going to see was the baby boomers, as they retire, freeing up a lot of inventory as they moved across the United States. We've run across several baby boomers that were selling their house and buying a house free and clear somewhere else, still left with some money, and and they're going to retire comfortably somewhere in the United States. But we didn't really see a lot of that. We're not seeing a lot of that turnover that we were looking for, especially in a place like California, where they came out and they said, oh, we want to make all the counties reciprocal when it comes to your tax bases. You turn 55 and you sell your house, you can move your tax bases over to another county. That was supposed to free up some inventory. And have you really felt any of that? I mean, maybe it just came at bad timing during the pandemic, but I haven't felt that that's really been noticeable.
I think the reason why it probably hasn't been noticeable because prices have gone up all in the outlying areas. The areas that people tend to be moving outward to, prices have skyrocketed so far. Those places are not bargained as they used to be as in the past. One of the things that I'm doing, ironically, 3 transactions along this line where people have built ADUs, auxiliary dwelling units on their property, moved into the ADU and is renting the front house house or the main house and for income and freeing up time to travel. So a lot of different people are doing different things. And once again, the ADU is a relative new concept from the last 3 years, and now it's becoming more and more popular because you can put more than one ADU on your property here in California. And of course, as the demand for housing, once again, that's another trend that's opening up the marketplace as far as another option is concerned as we start to once again predict future patterns.
That puts another not branch but twist to the whole freeing up of inventory. Is that now people are saying, well, should I sell or should I stay here and keep it and just go to build an ADU and then generate some more money? And as they continue seeing rents go up, and you see the county guidelines, state guidelines free up a little bit for those ADUs, or a lot, in fact.
Yeah,
they didn't free up a little; they freed up a lot.
One of those clients that I was talking about, she was planning on selling her house here in Oakland and moving to Las Vegas once again because of inexpensive housing. But she said, "Well, it's just so hot here." She prefers to stay here, but she's building an ADU in her backyard. She's going to live in here and once again rent the main house. The main house is going to far cover the mortgage debts on her current residence. And once again, as she retires from one job to another, free up more income, more opportunity to travel, more opportunity to stay close to her base, which has been in Oakland for the last 40 years. So a lot of, once again, different times bring different results and different options.
You actually just brought something up that it was an email from a while back this year, and somebody emailed me about their ADU, and they said it's an illegal ADU. Does that also grandfather illegal ADUs? Does it make it easier for somebody to convert that so that their neighbor doesn't call them and get a red flag on their title? Is there anything easier about converting and just saying, you know what, I'm gonna do it now. I don't want that to be illegal anymore. If I ever sell the house, I don't want it to be illegal. It's an issue. It's probably not really listing properly on my insurance. Has that become a little easier?
I think it's either most cities. I know for Oakland, because I do a lot of business in Oakland. Before you had an illegal ADU, they want you to tear it down. Now you can just go and apply for the permit, probably modify the house, make sure you bring it to ADU standards, and it's a lot easier now. I can't say it's on every different option, but a lot of different options. You can do a lot of different things, and because a lot of people used to convert garages into homes, city would drive by, see the garage door gone. So those things now they just kind of make you modify, show a plan, get a permit. At the end of the day, the city is trying to raise money, so
there's two things that can help you with. One, if it goes legal now, and it reports to the county properly, and there's no issues, lenders will that can increase your value. Now you can use that for your value,
and it's a bigger tax.
Right, and well, that might happen as well, but you also have more leverage too if you wanted to sell it or leverage it in a refinance, take some cash out, maybe do it to another property. Who knows? And second, there are programs, for example, that say there are people that don't have the money, they have a mortgage, they have an illegal attached unit to their house. There are programs that will allow you to fix that and make it legal and even upgrade the rest of your house at the same time, the renovation loans that we have. So you don't have to have money to do that. In fact, they use the higher value once it's complete, what they call as completed value, to calculate your loan to value, the future value of the property based on your loan amount. And you can take that money out and use that to fix up and get your stuff legal too.
Yeah, a lot of times when it comes to legality as far as units are concerned, ADUs, a lot of times there's a term that we always use is work done in a workmanship manner, or any health and safety issues, all those things. Once you have those issues covered, it's probably a lot easier now to get that permit process legalized rather than just doing it illegally.
Right. In the meantime, if you have an illegal unit, when they do an appraisal on a refinance, my angle was that you can get more value once it's legal. Appraisals, they'll accept it as long as it's done in workmanlike fashion, but they can't go out and get a comparable property. They can't, if you have an illegal unit and it's a 1-in-1, if you want to call it that, and they can't use 1-in-1s as a comparable. It has to be a 1, for example. So that diminishes your actual value. Because people don't go away, oh, my appraised value. How many times have you heard somebody say, that appraiser, he's not. I mean, we say it all the time. That guy was wrong.
We say a lot of times.
But people don't go by that. They go by what they think they could sell it at, and what their realtor's telling them. The other side of that is somebody's got to buy it.
And ADU's income. A lot of times now people look at ADUs. I see a lot of properties advertised in MLS, ADU, option, income, family, a lot of different options those ADUs bring to the table than they didn't bring before. And once again, it's another sign of the times in which the market, you can capitalize on another market option and just kind of make that house a lot more profitable, especially with the high costs and high taxes. Everything's gone up now.
You've seen larger lots sell for more now to invest simply because there's room to put an ADU And that's kicking out a lot of people who just want a single family, or that's all they can afford that price. You know, we saw a house, it was listed as 700, went for $1 million just because it had a side like a half lot on the side where you could build 1 or 2 ADUs. We're going to come back after this break. There's definitely plenty to talk about. We have an email we're going to get to and a couple more pieces of news. I'm Tony Mendez. That's Gordon Hines. You can always reach us at BayAreaLoanSource.com. That's BayAreaLoanSource.com. Or you can call the show, 800-516-1220, 800-516-1220. We'll be right back after this break. I'm Tony Mendez. That's Gordon Hines. The Real Estate Report on AM 1220 KDOW.
Tony and Gordon are taking your calls at 800-516-1220. It's the Real Estate Report on AM 1220 KDOW.
Give it up, Tony Lou.
Now that's a real maestro right there.
Ow!
There we go. You got something out of you. All right. All right. You can always email the show, Tony or Gordon at BayAreaLoanSource.com. That's Tony or Gordon at BayAreaLoanSource.com. This came from Steve. I did a refinance last year and took cash out. I got 3% interest rate. If I refinance again today for cash out, can I get similar rates? I owe about $450 and need about $100,000. That's a good question because a lot of people did refinance last year. They maybe saw their values go up and now they want more cash out, but they don't want to lose that interest rate. Where do you? And we don't want to steer you towards an equity line until we know more about you, but that's obviously an option. It depends on how fast and how soon you need the money and how soon you can pay it back. That determines whether or not you need an equity line. But let's say he doesn't. My opinion is yes.
As of today, he could be.
As of today, you still could, even though Freddie Mac has the 30-year fixed at 3.09%, but good credit, good equity, that can change. And plus, you can always buy it down if you had to. That's always an option that big lenders rarely give you, is the buy down options. And does that make sense? Your opinion?
Yeah, I think as of today, 3% rate's not a problem. I'm doing one right now. The lady, same thing. She's at a 3% rate. She's actually refinanced and taking some cash out. And the cash out, she's prepaying her daughter's college education into a 529C program, actually. So in other words, daughter's in in middle school, and she's actually refinancing and taking the cash out, put in the 529C for future value to pay that college education. So once again, she's thinking ahead, and these are other things that we can actually do. So it's not a problem. As of today, I don't see it to be an issue. Yeah, with the right qualifications, you can be close to the Freddie Mac survey, which again is a trend. If you go to Mortgage Bank Association, it's a little bit different, a little bit higher. But I like these emails because there were a lot of people, Gordon, that last year that took advantage of these low interest rates. There's people who got lower interest rates than 3%. Maybe he took cash out last time. Oh, he did. He said he took out cash, so that's why it was at 3%. It could have been a little bit lower. And they've been creeping up, but I think the rates are still there to take advantage of what we believe is the cheapest money you can get out there, unless you're borrowing it from your family. And as we always talk on the show, rates are what we call risk-based. So a lot of times it's the same people refinancing today. Two people can refinance with similar situations. The rates are different simply because one has a much higher credit score, a much better loan to value, have assets in the bank. All those things factor into your rate. So a lot of times is when you look at rates, not all rates are the same. It's like being in an airplane. Everybody in the airplane pay the different fare, and programs are like that now based on risk. Everybody refinance can actually be paying a different fare and it not be restrictive. And you just reminded me of something that we want to continue talking about. Yeah, something that did change. We always talk about how guidelines change. Let's say last year you did refinance. You wanted to get a rate that was everyone else was getting, but you couldn't get it because there was two people involved. To a co-borrower. It could be a spouse. It could be just somebody else. And they had a lower credit score. Freddie Mac and Fannie Mae are coming out and saying we're no longer going to take the lower score. We're going to average the scores together. Remember, this is important because now you can, let's say you had a 650 and an 800. Now your score is 725. So boom, that's a better score. That gives you a better rate, especially on cash out, and that makes a big difference. There are some people who might be able to take advantage of that. If you were listening, if you're keeping score, that's like 5 different things we just give going into 2022 and what the different market options are going to be. That's why people are listening. That's why we listen every Thursday from 6 to 7. We're here. You want it from the horse's mouth, listen to Tony. He's maestro. The horse. You're the maestro. And you'll get it basically whatever you want to know in regards to real estate, rents, programs, everything possible. That's what we talk about on a weekly basis. What do you think about
Single-family homes are being bought up by more investors as we're seeing rents. Rents are up 9.3% year over year, and investors in single-family homes, and we're seeing more and more investors foregoing the multi-units because single families they have a better stability, higher home price, higher appreciation in many cases, and they're now demanding more rent. As an investor, you owned all sorts of types of properties. Do you see this as a big enough motivation to put you towards single family homes?
I mean, there's a different. I mean, we always talk. There's a different mentality we find in the renter and from a single family home to apartment. Typically, single family homes tenants tend to be a little bit more stable. They're more family oriented. They tend to have sometimes their own appliances, especially if they're renting for a long time. I find there's a different market, more stability with a rental income, of course, coming from a single family versus the multi units. Multi units, people tend to move out a lot of transition. So, but single family tenants tend to stay longer, so it's a more stable tenant, even though you might not get the increases that you normally get with the people moving in and out the multiple units.
Would you go to a multi-unit if it was your first investment property or a single family?
I think it's always good to start with a single family. It's much easier to learn your rules with one person. There's a whole lot of things going to multiple units. Sometimes you can have a great building and just 2 or 3 tenants just don't get along and create havoc in the building, or one tenant could create havoc in that property. With his actions might cause 2 or 3 people to move out simply not because of the building, they love it, but because of that one tenant.
What do you think about the investor that's buying a single family, but they're going towards doing like Airbnb or renting rooms?
That's another different size of the marketplace. I think that market hasn't really played itself out yet as far as
I don't either. I think there's more to come.
Negative. I think there are a lot of changes still on board. It's a short term thing, and of course, everything is good when the money's coming in. When you have those long gaps of vacancies, I think that's where it begins to hurt you as an investor. So a lot of times you got to be careful. Once again, when you get into those kind of things, I believe you should have a balance. You should have monies coming from other sources to cover those windfalls or shortfalls.
So these are different levels of investing throughout your career of investing in your portfolio. Well, if you have any questions about any of these topics, you can always email us, Tony or Gordon at BayAreaLoanSource.com. That's Tony or Gordon at BayAreaLoanSource.com. We'll get right on your questions and answers. We'll come back next week. Thanks for joining us today. I'm Tony Mendez. That's Gordon Hines, the Real Estate Report on AM 1220 KDOW.